sales. Growth eases in April. Euro area. Inflation keeps ECB on hiking path. Nordea. Venezuela's Rodriguez to discuss energy ties during India. Visit from June 3-7. Polish zloty. Consolidation before breakout against euro. Societe Generale.
US dollar trades in tight range amid mixed signals on US-Iran talks.
Gold price forecast. Gold US dollar recovery stalls below $4,340 amid cautious markets.
Morning bid, equity supply shock. Eurozone inflation strongest since 2023.
Hong Kong retail sales. Growth eases in April. Croatia inflation eases to 5.2% in May.
Market mood improves as Middle East diplomacy stays.
Investing Live European FX News Wrap. Optimism continues to prevail in the markets.
Guess it's about time, huh?
Investing Live European FX News Wrap. Optimism continues to prevail in the markets. Croatia inflation eases to 5.2% in May. Euro area. Inflation keeps ECB on hiking path. Nordea.
Market mood improves as Middle East diplomacy stays.
Venezuela's Rodriguez to discuss energy ties during India. Visit from June 37. Polish zloty. Consolidation before breakout against euro. Societe Generale.
US dollar trades in tight range amid mixed signals on US-Iran talks.
Gold price forecast. Gold US dollar recovery stalls below $4,340 amid cautious markets. US dollar. Fed data support firmer dollar. BBH.
Yeah, baby, yeah! Hey, Wayne, let's go! Boom! Hey, everybody. Good morning. Hey, if you need a trustworthy, ethical foreign exchange broker, I've been working with Traders Way for over 11 years, about 11 and a half years. Give them a try. You love them. So good morning. Yeah, coffee and creatine and ghee and MCT oil. Yeah, and some bone marrow. Why not? So good morning. Guess what? We got another trading day in front of us. We got some jolts. That's the big thing today on the calendar. That won't happen during this session. That's 2 hours and
US
22
dollar.
minutes from now.
Fed data support firmer dollar. BBH.
Shh. Right? 2 hours, 22 minutes, and 22 seconds from now. We will have that thing that we call jolts. What is that? Job openings. We can take a look at that if you want. But we used to be well above 7. And if you go back in history, 7 million was the most, like the top end. And over the last several years, we've come down to 7. And now 7 is maybe the floor. I don't know. So that's what it's all about. So if you're reading in the media, or you've been told by the media that, oh my God, there's only 7 million jobs, the economy's collapsing. Well, back when they were saying that the economy was too hot, it was too hot, they had 7 million jobs. So we're right back to too hot. But remember, when we were too hot, what they're selling is, oh my God, the economy is so good and so many people have jobs, it's unsustainable and the whole thing's going to collapse. And now we're all the way back down to 7 million. They're like, oh my God, it used to be 10 and now it's 7, and that's definitely a sign that everything's going to collapse. I'm like, oh my God, the sky's falling, everybody. You better buy some newspapers and keep up with the news. Yeah, so anyways, that's where we are. My name is Wayne. I'm an economist. Yup. Specifically a macroeconomist. I even had the opportunity to speak at the St. Louis Fed to an audience of university professors around the world. Now, dude, you want to teach economics to tenured economics professors while standing on stage inside of the St. Louis Federal Reserve Bank? What a day that was. Yeah, what a day that was. But anywho, that did happen, and that means I'm here to share the good, the bad, the ugly. Now, before I was an economist, I was a trader. Yeah! Before that, I was a venture capitalist. So I know a few things about finance anyways. I guess while we're on the history, I worked for two tiny startups you probably have never heard of. One is Cisco Systems and the other one is Apple Computer. You probably have never heard of them. Before that, I worked for the original rocket company, NASA. Remember them? Yeah, which is actually quite laughable, right? They're like, it's our number one goal to go to Mars. You're like, why? Because Elon's number one goal is to go to Mars? Like, this is why I like entrepreneurialism. No one wanted to go to Mars until Elon said, I want to go to Mars. And then he builds a rocket company, and everyone's like, dude, you're so stupid to build a rocket company. So now he builds a rocket company, and it kicks everybody's butt. It's now 90% of the industry, and suddenly NASA wants to go to Mars. Good enough for government work, huh? So anyways, that's why I like entrepreneurs. You're like, change the future, make the future, invent the future, and everyone will follow. So cool, man. And who would have thought an electric car company? That's a dumb idea. Yeah. Now you sit at the light and you're like, dude, every third car is a Tesla. It's weird. Where did that come from? Nobody saw that 20 years ago, huh? Yeah. Anyways. So we are going to go through the world of investing and trading and try to use a framework to make logical, intelligent decisions based on quantitative analysis of macroeconomic data. Cool. Are you okay with using logic and intelligence? Yeah, why not? Yeah, let's start with the SITREP report from Aiden, so we know what's been going on since we last met. He updates this every half an hour.
Good morning, I'm Aiden. Let's get you up to speed on the current economic landscape. Today's market sentiment is showing a neutral to indecisive profile, with the daily risk score sitting near flat at 0.39, while the broader monthly trend remains firmly in a risk-on posture. Right now, we are seeing a clear divergence as rising bond yields provide a headwind to momentum. The U.S. 10-year yield has climbed to 4.475%, a move of 2.2 basis points, which is supporting the U.S. dollar index even as global indices like the Nasdaq 100 and Hang Seng attempt to extend their gains. The main focus right now is the U.S. dollar, which is finding support from recent Fed data. Over in Europe, inflation in Croatia eased to 5.2%, but broader euro area inflation figures are keeping the ECB on a path for further rate hikes. Meanwhile, market mood is slightly better thanks to ongoing Middle East diplomacy, and oil prices are dipping slightly as Venezuela and India look to discuss new energy ties. Gold is the big mover today, pushing higher even as analysts warn the recovery might stall near recent highs. Biggest movers right now, high-yield bonds and Bitcoin are down, Hang Seng, silver, and platinum are up.
Yeah, and that's that mixed market situation. So high yields down again. They were down yesterday. Bitcoin down. That's risk off. But the Chinese stock market and metals are up. Well, that's risk on. Ha! Well, hell's bells. So you're like, well, Wayne, that doesn't make any sense. Well, what do you mean it doesn't make sense? It is what it is. It is. 7:30. It's not early today. So it is what it is. There's different forces and also different time frames, and this is why we look at multiple time frames. So today is mixed, there is no doubt. So you have to say, well, in the context of larger time frames, what is it that you intend to do? See, most of the money in the market doesn't make decisions day by day like retail traders do. Retail traders are a tiny, tiny fraction of the market. And so you can think of, well, right now we're moderately risk on, but we're not necessarily adding to those positions today. Yeah. Versus today is up, yet tomorrow's down. Not necessarily. Tomorrow might be a dip to buy. So we'll cover stuff like that in a little bit because there's stuff going on like the New Zealand dollar, right? But anyways, we're up a little bit in the S&P. That's fine. It's been up for 9 weeks in a row now. So you're like, well, it hasn't done anything today. Yeah, but for those that are in medium and longer term, hey, things have been great. Things have been great. For day trading, it seems like you get going and it comes back, right? 2 steps forward, 2 steps back. VIX is still hovering around 16. We dropped below 70. Oh my goodness, that is a big move down. And I would look at that as risk off. Gold is up today significantly, and I consider that risk on. Now, maybe these correlations are changing. The relationship, let's say, with gold and VIX. And this is why we have the data. So this changes all the time, right? Correlations do change all the time. And so we could always check that and say, well, is this up another version of risk off now? Or is this up a version of risk on like it has been? And so, again, our correlation coefficients use 90 days worth of price action to make that determination. Price action relative to VIX. Oil, still around 90. I think it made it pretty close to 92. Great. So we're in a new range, 88 to 92. Dollar's steady. We've been at 99 a long time. And 4.5 on the yield. Okay. It's up a little bit today, but it's still at 4.5, which means we're probably stuck on 5.0 on the 30. Huh? Yeah. No.
Japanese yen. BOJ expectations clash with intervention risk. BN fine wise. Euro stores below 126.50 with all eyes on US JOLTS job openings.
US dollar. Fed data support firmer dollar. BBH. Investing live European FX news wrap. Optimism continues to prevail in the markets. Croatia inflation eases to 5.2% in May. Euro area. Inflation keeps ECB on hiking path. Nordea.
Market mood improves as Middle East diplomacy stays.
Venezuela's Rodriguez to discuss energy ties during India. Visit from June 3-7.
You can see, look at that, man. Hong Kong is on fire. Big day today, huh? Silver having a massive day. Platinum having a massive day. Copper having a massive day. Gold having a day. Look, all the metals. Are smoking hot like fire. So are you going to trade any of this today? Are you going to put metals on your radar? Remember, traders is radars for traders, right? Tradars, radars for traders. So is it on your radar? Is it on your to-do list? Are you going to pay attention? Or maybe you're selling Bitcoin today, or you're selling Ethereum today. So this is the situation we're at. We're flat right now. Even though some markets are moving, many are either not moving or are moving in opposite directions. This is no risk is risky. This means we don't know if we should be trading a risk on basket or a risk off basket. So we're essentially lacking macroeconomics. So your trade today, first of all, you're going to be a day trader. If you're a swing trader or position trader and like an investor, there's nothing to do. You're already in your positions and you're just waiting for the markets to wake up. You're just biding time. You're trading water. This shows you, okay, that you're trading water. If you are a day trader or scalper, you look at this and say, well, I have to do relative strength exercise. Okay? You want to just trade what's hot or what's not. The most hot or the most not. And that's what the next tab tells you. Just so you understand the logic of our framework here, as we go through our morning routine, okay, is there a buy and hold situation today? No, not really. Okay. So what should you be trading? Okay. Don't worry. I know this animation is distracting. For some reason, he added that today, and I'm going to get rid of that. I don't. Why did he do it? I don't know. That's just too much. I'm going to have a seizure. But anyways, we can do it this way. Or this way. Okay, he's got some changes here. All right, let's do it this way. Do you notice the change? Bullish column, bearish column, assets and indices. He changed the name on me too. Yeah. Oh, AI is so fun. All right, that's not gonna. It's supposed to say, I don't know, not that. Anyways, but what we've built here is commodities and indices priced in dollars. Okay, I don't see the indices. Okay, you forgot to add indices. Okay, so we'll get to that. But so there's supposed to be crypto, commodities, and indices here. And these assets are all priced in dollar. So we have a very similar layout for these cards. They used to be different. Well, first of all, we added these recently, but they were different. And I'm like, no, we have to display the same kind of conviction, right? And so now the cards are similar, but to do that, we had to indicate whether the commodity itself, the asset itself, is strong or weak, and then what is the dollar doing. Now, I can see it didn't do it correctly. So this is something I'm going to work on like practically now. You know what? Just so I don't forget, I'm going to tell him right now that he's done some mistakes. Hang on. So this is why you got to know what you're doing. AI is stupid. Remember that. AI is not going to replace smart people. So how could the dollar be plus 2.8 when the dollar is plus 2.22? Okay. All right. So we can come back to that. He's going to do it now, I hope. But you can see where we're leading here. We need to have some congruency in our methodology so you can decide what you should be focused on. These are day trading assets. And over the last 2 or 3 days, New Zealand dollar's been strong, but it is currently weak. That's just how it goes. Now, we know it's been strong because if you switch to swing trading, Kiwi is strong, Kiwi is strong, Kiwi is strong. It's just not strong now. Or if you're like, well, that's hard to read, well, then go to this view, make sure it's swing trade, Kiwi, Kiwi, Kiwi. Or go to this view, okay, Kiwi is the strongest, followed by Aussie, followed by Euro. Yen is weak, CAD is weak, Swissy is weak. So you should be selling these things in general and buying these things in general. But you'll see that Kiwi is weak now. Well, maybe that's the dip you need. So this is very logical and very, very helpful if you organize your thoughts. But if you're just looking for a signal, okay, then just stick to here. Kiwi is weak today. But I think most people want to know that it's been strong. So the weak today might be the dip you buy for the rally tomorrow. Or not. It's your job to do the analysis. Okay? But anyways, I think we're going in the right direction. I hope you guys agree. Is FX Bootcamp active? No. But Investor Bootcamp is still active, and of course, TradeRs. But I retired FX Bootcamp on its 20th anniversary. Big Perm FX says, hey, NVIDIA must need metals for their CPUs. I was listening to, who was it? I think it was a copper analyst. It might have been a copper miner. Ain't no copper miner wiener. Maybe it was a copper miner being interviewed, and he was talking about the extraordinary amount of copper specifically needed for each data center. And it was a lot. So Big Perm, yeah, for sure. Hey, Nuno. Yeah, hey, Nuno, thanks for your emails and stuff. Let me just say, because it's easier to say it. I did read your emails, but I wasn't in a situation to respond with any detail more than thumbs up or thumbs down. Um, the I don't. So Nuno asked a question about macroeconomics and setting up a theory, right? It's all theory. So I could say you're right or wrong. I don't know if you're right or wrong. I don't know if I'm right or wrong. I don't think you said anything stupid in your analysis of macroeconomics in your email. But you wrote an economic thesis, and I would have to like grade it like a university professor and write it back, which takes hours, and I have seconds, not hours. But I don't know if you're right, but it didn't seem stupid. What the challenge with being a trader and an investor is entering safely into your theory and managing risk. So you could start with the theories that you outlined, which, no comment, but you have to use the analysis as well that is less macro, let's say more micro, more technical, and more seasonal to place trades and manage risk accordingly, and be extraordinarily open-minded to being wrong. So one of the concerns I had was sort of what I might have read into your analysis, but sort of an all-in conviction. This is my theory, so I'm going all in. That is what scares the heck out of me. And those that are in this business for a long time are very willing to be wrong because they have suffered through periods where they had the all-in conviction and went through a bloodbath experience or two or three. And the survivors learn to avoid that. And maybe we're lucky not to have gone all in on a conviction and then lost it all so that you never had a second or third chance. And I think that happens more often than not. So to go through, to be wrong and face a significant bloodbath, if you're lucky, you survive. But most don't. So those that are stuck around for the decades, okay, have a very, very strong opinion based on their analysis, like what you may have done. Okay, Nuno? But you have a weak conviction. Very, very strong opinion. I know exactly what I want to do and why. So you have clarity. Clarity to enter trades when you can prove that that is happening, that your theory is similar to what reality is, but also the clarity to know when it's not. And that is far more important than knowing you're right. The biggest skill, I think, for professional traders is knowing that they're plausibly even not right. Even if they're still plausibly right, they start behaving like, ooh, I may not be right. So it's like an experienced poker player throwing away a king jack. An amateur might say, well, that's a really strong hand. But a professional might say, in this circumstance, right? I'm looking at 4 cards on the table, 2 cards in my hand. I'm watching other people bet, and I'm doing calculations in my brain of probabilities. And even though this is usually a pretty decent hand, under this situation, I have a pretty reasonable chance of losing. based on what I know is in my hand, how I see behavior around me, which we call sentiment, and the cards that are on the table, because they may match what I have, but they match what the other people have, which, right? And so you can look at that and say, well, this is normally a hand, but, I'm pretty close to 50-50 in reality based on what I see in this situation. So normally a good hand you would keep, and you have a pretty decent chance normally of winning. But if you've ever played poker, when you lose, you are certain you have the best hand. Certain. And then you realize, oh my God, there's an obvious flush sitting right there. I'm like, you didn't notice the 4 hearts or the 3 hearts? Someone just needed 2 hearts in their hand, right? And you just didn't see it because you were certain that your pair of jacks with a king high is going to win. You're just certain of it, right? That's when you lose big. When you have high conviction, so high of a conviction, you don't see the other details around you. You get blinded by certainty, and you don't want to do that with your life savings, right? The name of the game is survival. Staying a trader, staying in an investor for a long period of time. So when I work with endowments, I say, hey, this portfolio that I design will be designed to last in perpetuity. Okay? And people are like, yeah. And then I say, do you understand I'm thinking 300 years in advance? Oh, they're taken aback by that. Like, they've heard it, but they don't get it. And it's the same thing like you want to die with all your money and then some, right? You want to live rich, but you want to die rich, which means that you have to be prepared to throw away a king jack in certain circumstances and not be certain you're correct. And so I might have read that in there, like you created the thesis, you believe it's logical, and I'm not going to say it's right or wrong, because I don't know if it's right or wrong. Most of it can seem reasonable. I can misinterpret my own data too. AI can get it wrong. Nobody knows the future. Things always change. So you start with that hypothesis, right? No, I know you don't. But what I'm saying is the psychological impact of certainty leads you to behave, even if you're not a gambler. The psychology can lead to it, and it's usually very slow. Okay, So I'm not saying you, but so you know what you intend to do, and that's critically important to understand when it's not actually happening. Forget about being right. Knowing what you want to do is going to help you know when you're wrong. And if you have that attitude, I think you'll be fine. The rest is patience and discipline. So like today we're looking at, Kiwi weakness, right? But is it actually weak? Let's go to this one. Is the Kiwi actually weak? No, not over 30 days. Okay. And not over 7 days. In my opinion, there is never a good reason to go all in on high conviction. Lots of people are going to disagree with me, but I'll tell you what I see and what I've learned through observation. During the 2008 crisis, I forget the guy's name, but he got famous because he went all in on gold, and he made like $1 billion in a day for his investors. But it was a smaller fund, and it wasn't his money. So he went all in and, made $1 billion, made 1,000%, that kind of stuff, right? So how do you make 1,000% in a year? You go all in and you gamble, right? It's a gamble. You go all in. And these are the guys that, unfortunately, you read about in the newspaper and you see, you read about in books. Oh, whoa, this guy was one of the greatest traders in the world because he made 1,000% in a year. I look at that as the dumbest thing I've ever heard. But that's not what gets written. Also, what doesn't get written is the same guy then was famous because he got lucky, in my opinion, on that gold trade. He went all in, gambled it all, and, won big. With smaller, quote unquote, smaller amounts of money. So now he's famous, and he goes out and he raises a second hedge fund 10 times bigger than the first one. Because he's like, dude, last time people gave me money, I made 1,000% in a year, and I gave him $1 billion in profit. So then he goes out and raises a fund 10 times bigger, and he says, I'm going to do something similar, but now I'm going to not do it with gold, I'm going to do it with miners. And the part that you don't read about is he lost all their money. So in a way, he actually lost 10 times more money than he ever made. I don't like it. Yeah. I don't like it. I also don't like turtle traders. They're famous. And why are they so good? They hold trades for long periods of time, but don't manage their risk. Once again, they're praised and famous, and people sell all kinds of books on the famous turtle traders. And yet, it's some of the dumbest trading I've ever seen. It's dumb. Okay? So our goal is to remove all of this stuff. Okay? My goal as, a manager of endowments, of sort of a data scientist of macroeconomic data, is to remove as much of this uncertainty as possible. To win big, you must risk big, which means you have the capability of losing big. And it's easier to lose than win. So I think the eventual outcome, if all that logic is true, if you agree with that, no, maybe you disagree with it, that's fine. But again, if it's easier to win than lose, then more often than not, eventually the loss comes and it's devastating. And the wins usually come with smaller amounts of money, and the losses usually come with bigger amounts of money, right? Right? So the first small fund, you 10x it. The second one, you -1x it. -1's -1. Right? You're out. So I would rather you learn. And by the way, I'm not saying you don't ever have to do that. You have to do what I'm doing. But I am leading to something that might be helpful here. I want you to learn how to do quantitative analysis so that you can almost print money. Meaning you are aware and address risk as much as possible so that the logical outcome is a rational profit. And if you cannot rationalize the profit, then you have too much risk. Or there's just no real opportunity for what you're doing. So through financial engineering, okay, you can produce an outcome. For example, at the CIA, the Council of Investment Advisors, which is meeting on Monday, CIA, I teach how to do this. I teach how I do this with charitable funds. And we were able to reduce risk by 70% and produce 12% no matter what. No matter what happens. And you're like, well, Wayne, the stock market's up 25. Yeah, we'll wait till it's negative 25. You know what we're going to earn? 12%. So I'll beat the market by 36% on the way down, and I'll lag a little bit on the way up because I've taken out all that risk and volatility. But I'm getting paid consistently. So the market goes up, I make 12%. The market goes down, I make 12%. Well, if you have $1 billion, what are you trying to do? Make $2 billion? That wouldn't change your life. How about going from $1 billion to only 100 million? I've talked to people that have gone through similar situations, and it's funny because they're like, holy shit, I only have $100 million in the bank. Oh my God, what am I going to do? It scares the bejesus out of me. Yeah, when you're down to 100 million, it's a lot different than when you're up to 100 million, you know? So I want you to be able to do that. Now, what I'm trying to say, though, is once you're in that situation, then can you improve your performance by tweaking your basket? Okay, now, if we're going to do mathematics, think of it as changing the skew of your risk tolerance based on data. And you could say, because of geopolitics, things have changed, so you're going to adjust. Or you can adjust based on seasonality. So like certain times of year, you may have a higher conviction for risk on and a lower conviction for risk on, and you adjust. And that's where you can kind of that asymmetrical return, you know, your alpha is going to become not from taking on more risk per se, but because of quantitative analysis of this data, you know when to change the skew. Aha. It's a form of rotation and rebalancing. And you can eke out, let's say, instead of making 12%, let's say you make 15% a year, just by adjusting slightly, but you can prove quantitatively you're actually not taking on more risk. You're just removing some of the hedge because you have the data that says you can. Okay? That's also much different than, you know, going big. Because if you can go big, you can also lose big. So in the hedge fund world, they kind of get paid to do that kind of stuff. But here's like I was just at a hedge fund conference, and I remember this guy. He was an academic person, and he looked, I think it was private credit or private debt. Private equity. I think it was private equity. So he studied private equity in massive detail. And he created an index so that maybe people could invest into an index of all the private equity players that he could track sort of mathematically and kind of recreate an index that you could then invest in, right? But he was going through the study, and he's like, you know, no one would invest into this type of asset unless you would beat some sort of benchmark. And he says, it's very interesting. When you look at it from an index level, it's pretty good. But when you look at it to, like, we'll call it a hedge fund level, which hedge fund do you invest in? When you look at it over a larger period of time, let's say 10 years, okay, none of them beat the benchmark. And even the best ones that were really good in one or two of the years always underperformed in the following years, and vice versa. So, like, the best in the 10-year period had good years, but most of the time they didn't. Right? And so if you managed your own portfolio that way, you got to think about it. If you are going to have that all-in philosophy from time to time, there will be statistically a year that you do really well. But also statistically, now based on very, very smart and experienced teams of people, even they cannot consistently outperform over any real period of consistency. Okay. So I would then say learn from the masses. So if you looked at 50 of the largest private equity firms in the world that are managing billions and billions and billions, even trillions, and they can't get a consistent return. Okay, I learned from that. And so what I do, again, in contrast, is I engineer my portfolios to not do that. So if somebody is, if the stock market is beating me, it's making 25% this year and I'm only making 12, I'm okay with that. Because I know if or when it drops 50%, I'll still make 12. I'll make 12 forever. So now I can plan it all out, and I know how much money my endowments will have in the future. So, like, I was at a board meeting, and our accountant, right, the chief financial officer, she did the books, and then part of the books were the endowment, and she had estimates going out, let's say at the end of the year, but also in 2 years and 5 years, right? Okay. And I'm like, how do you get those numbers? Because that doesn't match my analysis. And she said, well, I used a conservative number. I'm like, well, what's the conservative number? And she's like, I Googled it, and it was like 7%. I'm like, I have it predicted out to the penny. So here's my number. And everybody laughed. I'm like, at the end of the year, this is how much money is going to be in the account. And I had it to the penny. And people laughed. And I'm like, well, it's true, because I'm looking at, I said past performance does not predict future results, but this is what's happening. This is the mathematical projection. Adjusting for everything already in the model, this is the outcome. And it will differ, but not by much. And so if you're going to just use a percentage as a guess, you need a much better guess, because that is not possible, right? And so what I'm getting to is endowments and family offices and your household billionaire. This is what they care about. They're not trying to make a lot of money quick. They're trying to protect their money at all costs and beat inflation and pay the rent. Isn't 12% elite in the hedge fund world? Well, so you have to compare me with, so I met a lot of real estate people, at this hedge fund, but 3 or 4 different types, 3 or 4 different funds doing 3 or 4 different types of real estate, and there were quite a few other types of hedge funds, right? And I've met with a lot of hedge funds over the last, because I was at two other hedge fund conferences recently, and we're all different. We're all different. That's the thing. So isn't 12% elite? Well, when you meet with like a real estate person, they'll tell you that their internal rate of return is 20%. Now, the trick to that is they're only counting the money they're invested, not how much money has been given to them. So they might have $1 billion, but let's say only 500 million invested. So they're like, oh, but we're making 20%. Yeah, but you're making 20% on the 500 million, but you still got 500 million of my money that you have done nothing with, right? So I would argue it's 10, right? There's those kinds of tricks, but also how much risk do you have to take with it? What kind of liquidity do you have? What kind of volatility is associated with it? How sensitive is this investment to changes in interest rate policy? And you start getting all these different numbers. And so if you are, let's say, conservative, and you're also income focused like a charity is. This is why I do charitable endowments. They need the income, and they can't take any risk. So if you're that type of person, but you might be a family office and you're like, hey, because honestly, I've talked with many family offices over the last couple of years, and one of them, they managed for one family, several $1 billion. And I said, like, what's your target? What's your hurdle rate? And they're like 6%. 3 to spend, 3 to cover inflation. So if they make 6% a year, that family can live. They never touch the billions. So they know if they can achieve the 6%, which they can do very, 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 very conservatively, even maybe through treasuries and some other alternative type investments, they eke out the 6, and the family could live on $500 million or $50 million, let's say. They can live on $50 million this year and never touch the principal. That's all they care about. Like 50 million on, let's say, 4 billion. You're like, that's hardly anything. It's enough. It's enough. You can live on $50 million a year, every year, forever. And in the first year, you buy a big house. The second year, you buy a bunch of cars. And your third year, you buy a yacht. The fourth year, you buy international property. In the 10th year, you don't have anything to spend your money on anymore except maintenance and depreciation. And all of a sudden, you're like, and you still got your 4 billion, but this money comes in and it's too much to even spend. That's where you want to get. And so to a customer like that, a client like that, I come in and I'm like, well, I have more risk than a government treasury, but I have less risk than the stock market, and I produce income and low volatility. My 12 looks pretty good to their 6. So then we say, well, how do we squeeze this into your portfolio? Of course, you don't want to put all 4 billion into it, but what percentage? So if my low risk portfolio to their ultra low risk, they could say, well, we can allocate a small portion of our ultra low risk to your low risk. It's within our mandate, because putting a few million out of their 4 billion into a low risk versus the ultra low doesn't change the risk profile of the ultra low. And these are mandates that you have to follow. And then even for endowments, we have to follow these rules, and they're built into the paperwork. And the custodian has to make sure that the portfolio is following these rules, and it has to be reported to the board. And so the family office would have something very similar. But they're like, hey, we got $4 billion, we gave him $4 million. That bumps up the income a little bit, but without changing the overall risk portfolio of the family office. And it's a nice little part of the overall. Cool. Right? And for me, $4 million would pay, $50,000 or $60,000 a year. Cool. Yeah. So you have to know your customer. But your rich uncle or your mom's dentist that throws you 50 grand, they probably want high risk because they have very little to lose. And a low level of sophistication, right? Is the goal to create a profitable, consistent trade plan to show a good track record to manage other people's money? Yes. And whatever that track record is, you have to continue to do it. So, for example, am I doing an ultra conservative investment strategy just to show that I'm low risk and high consistency, and then go out and start a hedge fund, which I then take on high risk for high reward? Well, then your track record would be unusable. Your track record is to say, this is what I am going to do with your money. And if I do something different, you can sue my ass. Okay? So if you want to do the high risk stuff, then here's what I recommend you do. Earn 1,000% trading Forex and do it for 5 years in a row. And show that you have a good Sharpe ratio. And you'll definitely find investors. Here's the thing. You won't do it. It's just not mathematically likely. Okay? It's hard to take on risk and win consistently. It doesn't even mathematically make sense. But if you're that good, and but I'll have to remind you, if you look at the 6 degrees of separation, I used to work with George Soros, and I've personally communicated with Jim Rogers. He even sent me a Christmas gift a couple of years ago. So, do I hang out with these guys? No. But have I worked with them, communicated with them kind of thing? Am I within 6 degrees of separation? Yes. Now, why do I bring these two gentlemen up? Jim Rogers and George Soros ran the Millennium Fund, and they made many times 1,000% a year over many years. This is why they're famous. They've also both gone bankrupt. They forget to talk about that. George Soros has been bankrupt 4 or 5 times. Why? Because he goes all in and makes $1 billion in a day, and 3 years later he's bankrupt because he went all in again and didn't win. The other thing is they take years to build their position, something that I don't like to do, and I've learned not to like it. We'll call it a survival skill. So I'm not willing to lose money for 3 years in a row to make money for the next 5. Right? And so remember, that's what you have to do to make 1,000%. You have to be very, 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 very wrong, because you're let's say, short selling NVIDIA. That NVIDIA keeps going up, and you're like, there's no way this is true. And NVIDIA goes up 1,000%. You're just losing extraordinarily an extraordinary amount of money, and then something happens and NVIDIA collapses. Jensen Huang is in a car accident. Bada bing, bada boom. You see what I mean? And all of a sudden, ha ha! I'm right. I was heavy short, and now I'm rich. You're like, that would be extraordinarily stupid, in my humble opinion. But I've seen George Soros do it. And I've told the story many times where, because of my connection with him in my early days of trading, I would read in the newspaper, George Soros is shorting the dollar. And it would stand out because I'm like, well, holy snickerschnocker, the dollar's strong, and I've been buying the dollar. I'm selling euro dollar. I'm crushing it. I'm making a ton of money daily. See, I'm day trading. And I'm like, and I've been doing this for months. I'm buying the dollar. George Soros is selling the dollar. He must be an idiot. Well, guess what? Over the course of months, maybe even a year, the economy changed, right? And the Fed adjusted its policy. And guess what? Then it dawned on me, because I kept reading the article, that, I could see his position, and now that position is correct, because the Fed changed their policy because the economy changed. And now all those losing investments he was making, right, were now growing in profitability, and now I was no longer selling euro dollar, I was buying euro dollar, because the dollar was weakening. And then I realized George Soros was just building his position. Okay? And I said, so he's not stupid. We're on 2 different time frames. But I don't have the inclination, nor the pile of billions of dollars laying around, to be wrong for a year and then keep buying or selling more. You see? It took him a year to get enough. Where I would rather say, I too want to track the economy. I too want to track macroeconomics. I too see the value, but not now. And I'd rather, instead of accumulate on the way down, I want to trade the smaller time frames, so I start my accumulation process closer to the bottom than front run. I just can't front run months and months and months and months in advance. Okay? So, for example, we have extraordinary geopolitical risk right now. My assumption would be the dollar in general would be strong in a scenario like this. But if I can imagine a world where there is a resolution with Iran, Straits of Hormuz open up, oil starts flowing freely, okay? I can also imagine a world where there's a relief rally and the next 3 or 4 years are up in the stock market. because political risk inside the United States, we would have made it through the midterm elections, and there'd be 2 more years before we have that kind of problem. The perceived risk would be gone. We still have the AI thing going on, less perceived risk. So I would imagine the stock markets go up. I would imagine a world in which the stock market goes up. The dollar is no longer strong, but in fact weak because of the way that global macroeconomics works. If Americans feel rich and they're spending their money, they're buying stuff from foreigners. They're buying stuff made in Japan and China and Germany. And that means they're buying stuff because the economy is good, but also they're trading their dollar. They're selling their dollar to buy a BMW. So the value of BMWs go up and the value of the US dollar goes down. Okay, so when things are good, the dollar's weak. Great. So I can imagine that. And but when the dollar is strong, I don't want to create this massive short position while the dollar is strong, while there's geopolitics. Now, George Soros might. So all of this goes right back to that same question, like you might be 100% right. That is a good start. The second thing is deploying the capital and building the positions when you can prove you're right. And then still having enough clarity to remove confirmation bias. And in fact, when you're making money, and everything is right, you're still looking through the lens of what if I'm no longer right? And that is a survival mechanism. And right? And that's probably a skill that you have. And you want to incorporate that as much as possible. Right? You're strong and you have survival instincts or capabilities. So to add both of those into your trading will help. I'm not saying you don't have them, but that's the next step. The thesis is one, then there's the positioning, and then the management. And they're even more difficult. Right? Yeah, the timing, it's where the money is made or lost. Well, for us. But again, for George Soros, he can be wrong for 2 years and it doesn't bother him. And Jim Rogers did the same, right? And who runs it now? Druckenmiller? But anyways, these are all big investors, and it's a different game. Unfortunately, those things are sort of mistaught to the industry. So you read that and you're like, well, I want to be like George Soros. Oh, really? You want to go bankrupt 5 times? Well, here's what I suggest. Your first trade, you should make $1 billion. And then your second trade where you gamble, make sure that if you gamble and you go bankrupt, make sure you've hidden 100 million somewhere so you don't have to live out of a garbage can. And then say, well, I got 100 million in the bank, so I'm going to go all in again. See if you can make another billion, but never lose your 100 million. And all of a sudden, you're slowly starting to think more like me again. Okay. Is a Michael Burry shorting the market? Yeah. See, like, what's that movie? What's the name of that one? The Big Short. Once again, I hate that movie because people that are not professional investors, they watch a movie like that, or they watch The Wolf of Wall Street, and they're like, Wayne, that's what you do? Hell no. Somebody losing money for months, okay, other people's money. And remember, he stopped returning his partner's call and everything. And like, dude, no. Michael Burry, in my humble opinion, is probably the worst trader and investor in the world. Wolf of Wall Street, he made money by lying. Why would I think that's a good movie? So now people that don't know anything about investing, they think Wall Street's like that. No, he went to jail because he was a criminal. And what he was doing was legally and morally wrong. What a loser. Okay? So, no. You know what I like? I like helping charitable endowments run their charities more profitably. So at some point, I'll be dead and everybody on that board will be dead, but that charity will be alive and kicking. There'll be all new people around the board table, but we will still be serving our community. That takes patience and discipline and a big, fat, juicy brain. That's what I admire. Okay? Yeah. So anyways, I got to go. I got a busy morning. And the market's going to open soon. And we got jolts at 10. Like, oh my God. Oh my God. So that's it. If you have a live subscription at TradeRs, I'll see you at 4. Remember, most of TradeRs is free, which means your mother would be very disappointed in you if you didn't sign up for something this valuable that costs you no money. You ain't got no money, but you want to be a trader. Well, why don't you at least start on the data side? Start there. Try to put some logic and intelligence into your trading. And you're like, so therefore you can say, well, what do you want to do today? Well, there, I just answered the question. Pound Kiwi, Euro Kiwi, Aussie Kiwi. Kiwi dollar, Kiwi yen, Kiwi cat. Okay, it's labeled. That's today. But on a longer period of time, we have the actual opposite going. So now if you really want to put another level into your trading, you're like, well, Kiwi's down today, but up in general. Well, maybe that's the dip that you've been looking for.